Hi, I'm James Twomey, and welcome to the Twomey Stock Market Report. Today is Monday, December 12th, 2022, and we are in the midst of trading on Monday. It's about 11:15 Eastern Standard Time. And I want to go over a couple of items because we've got a lot of news coming out this week, and we're really at a crossroads from a trader's perspective. And I want to just align some of those thoughts just in case we have a major direction shift. Okay, so let's see. What's the best way to approach this? We're going to go over a couple of quick subjects. Market update, add or sell the positions. I want to expand upon that. We're going to look a little bit at the daily chart more than the 120-minute chart in this particular segment, but we could compare the two. We have had some discussions about some interesting technical indicators kicking off, which should be bullish, but they have not materialized at this point. We're going to tell you why. And then we're going to go into what's next, a little bit of a discussion on how the market is shifting, right? So first of all, recession is the big subject, right? Everything is all about recession the past 10 days on the news cycle. But what's our four tenets of our recession? They are the inverted yield curve. That's where the short-term bonds pays more than the long-term bonds. That's happened several times throughout the year this year. So we've been in that mode for quite some time. 2 quarters of negative GDP is another technical description of a recession. We did hit that. And while we had the inverted yield curve, so we were 2 out of the 4 tenets that were flashing recession, and typically the GDP negative 2 quarters is viewed as institutional. Yes, we're in a recession. Well, that reversed and went positive last quarter, so that erased that issue. PMI below 50, that's the manufacturing index. We've been watching that all year. That did drop below 50 for last month, and that means that there's a contraction in the manufacturing sector. Yes, the U.S. is not primarily a manufacturing country anymore, but it still has rippling effects because it's goods, services, it's supply side. It's a lot of information that gets tucked into that PMI if you go under the covers. And that's telling us is if below 50, if that continues, manufacturing is going to inventories will build, and then there'll be a contraction of labor needed to build inventories because you don't want to overstock your inventories, right? So it leads to layoffs. If that sector starts laying off, along with what we've seen the crack in the high-tech sector, that could be really devastating to the economy. So right now, we've got 2 issues on our recession tenet to be concerned about. Expanding unemployment is the fourth. That has not really materialized. Yes, we've had some pullback, especially in the high-tech sector, but now we're seeing with the manufacturing. So that's more on watch. But we hear a lot of people saying that their companies are starting to struggle. They're reducing their offers. They're reducing their hiring numbers, and they're looking at potentially laying off after once the new year starts if things continue negative in their forecast. We'll see. Right now, 3.7% unemployment has helped the economy because why? If people are working, they'll pay the higher inflationary costs that we've attributed over the past 10, 12 months. So that's helping. If they start losing their jobs and inflation remains at these levels, then we've got a more devastating impact to the market. So right now, we're 2 out of the 4. So we've never really eclipsed the 3 out of 4 or 4 out of 4. So what is that telling us? Yeah, we're on the cusp, and that's the problem. And then that's why the market is struggling right now. Everybody is viewing this as what's next, what's next. And when you're always awaiting that next piece of data, what subsequently happens, everybody tightens that data information cycle and start looking for key information and on a shorter duration and shorter signal or data that really is more short-term indicators than long-term. And what happens, we become reactive traders and we start selling and buying, and that causes problems. And also what happens is we start getting into, where the recession will bring us or not bring us, right? So the Fed is reducing its rates. It's going to go 0.5 here in December, and then next quarter of 2023, they're proposing they want to get to like 5.5%. After this raise, they'll be 4.75. They'll be near closer to their numbers that they're looking at, and then next quarter or half of the year or next year, they'll try to get that to 5 to 5.5. So there's going to be smaller cycles. So next February, maybe 0.25 versus 0.5 if things continue as is. Now, and once the Fed stops raising rates, that's a signal for people to go heavy into the market because stocks will have less headwinds. So what's happening now is a lot of people are trying to time the market and get in a little too early, find disappointment, sell, and they rinse and repeat, and hence volatility. Year end of the market, do we expect much? No. So I want to go over a couple of quick charts before we go into our sector table here. And quite frankly, I'm going to go right to, we use the SPY as our market indicator of the trend, right? So overall, year to date, it's been, no surprise, this big magnitude red line, right? The trend line has been down. Every time we kind of come up to it and break it, we retreat. Well, we were very positive. We were starting to get more bullish because we were, this is the daily chart to SPY. Took 10 to 15 days playing around with this 200 EMA technical indicator. We also know the Fed's starting to reduce its rates. We also saw inflation kind of leveling out. We saw some companies, starting to, the breadth of the market. We had only 50% of companies now trading below the 200 EMA. So, and it had been down to 80 way back. So we're starting seeing more, and then it went up into the 40%. We saw more companies participating in advances in the market. First time all year, quite frankly. So now what happens is we eclipsed that 200. That worked. We were positive, and then all of a sudden last week, recession talk, and beat down the market. And now it's at our lower trend, upper trend track line of this blue. It's starting to level out here and actually break it, but we're looking, and then we're also seeing how our 9 and 14 EMAs are flat, and they're starting to, if that crosses negative, that'll be a sell signal. We're not quite there. We're down here at the stochastics is our fast oscillator. We saw how it was up in the 80s, 90s, and then it went quickly down to 9 or 8, which is definitely towards the oversold. It's fighting to go positive. This is our short term. If we see the green go above the red, that tells us things are starting to, prices are trying to advance. If it gets up to 50 to 75 range, I don't know if you can see my cursor here, then we know more stronger prices or upward prices coming. We're nowhere near that now. I think today we're 20 up off of the close of 9 of last week. Look at the MACD. The MACD is still above zero, which is positive, except the green has now crossed below the red, showing pressure, and that's our longer oscillator, moving averages. It doesn't cross as often, and it takes quite a bit of energy to get it up into the positive territory. Well, that's got a negative slope. We need that to flatten out and the green to now recross the red. Otherwise, we'll have further lows. So we're at a cross point because three things. Stochastic, negative territory has not told us that it's on an upward trend. MACD is on a downward trend. And then if you look up here on our daily chart, the 9 and 14 EMA are about ready to cross. We're at the lower end of our trend track line. Very, very difficult to go much lower without generating a sell signal. So now we've got the CPI coming out tomorrow. If that edges up like the PPI, we'll expect selling. If it comes down a little bit, we'll expect the markets to rebound. So therefore, we are in that reactive trading phase. Very difficult because it's going to move quickly one way or the other, especially if it comes in higher. even if it's 0.1 or 0.2% higher, the market's going to take that. And then the sell-offs are always faster. The declines are faster than the increases, right? So, this is the problem. We're at that inflection. So what do? We've tightened our stops. We do have some stops. If we get stopped out, it's okay. So if your stops, if you're trading the SPY, you want to put your stops at at that 50 EMA here. And then if you get stopped out, so be it. You come back and fight again. You don't want to ride this all the way down, because if it does, look at this, the big picture now. Every time it goes up higher, comes down, it goes higher, comes down. It's lower lows, lower lows, lower lows, lower highs, lower highs, lower highs. If we do break this, if we break the 50 EMA and we break below that towards the end of the year, we can have a cascade sell-off, which could be pretty volatile, and then bring us, at that point, it's a good ride, probably a ride to the bottom. Don't know. I think we're going to be, a lot. Unfortunately, we're in that reactive trade. So I tell people, caution. If you get stopped out and the market races off, you can still get back in. If it races down, you're protected your capital. So there's nothing wrong with that. If you look at the diamonds, which has been the stronger, that's our proxy for the Dow Jones, has been the stronger of the two. This is a great example. This is a daily chart. We had this upper trend forming, these red lines, and then it broke from that, and then we started a lesser sloping uptrend. And you think about it, right? In order for this is kind of easy, but it's all easy analysis, but we're trying to give you a picture, right? So once it breaks that trend line, in order for the trend line to flatten out like it has, the prices have to come down. So we're seeing prices abate. There's a couple of things here. The stochastic is, again, 0, but it's fighting to go make a positive pause, but it's nowhere near 50 or 75, which will alert us that prices are heading up. MACD, just like the SPY, not looking good. And then up here, we're below the 9 and 14 EMA and right near a sell signal for our system. And the only other thing here, we saw the 50 cross above the 200, which is we call the golden cross from a technical. That usually means it's a positive bent to the market. Technically, it takes a lot of energy for the 200 to get up and cross to the 50. I use exponential moving averages. Some people use the moving averages. Simple moving average is just an average, right? Versus putting some exponential puts a little more weight on the most recent data. But with that said, the moving averages haven't crossed positive yet, so you're not seeing a lot of that news out there. This has crossed, and actually, no surprise, people are using a lot of this as a sell signal versus a buy signal. I'm surprised at that, but we'll see what happens. So again, nothing's looking really one way or the other. So I want to leave you with this. We're going to tighten your stops. If you get stopped out, that's fine. You want to be able to move and come into the next day, even if you have to get back in. But if the market drops off and you're long, you could be devastated. Now look at this. This is our sector table. I sort it by 1 month, and just from last week, all these things, it is flipped. Utilities, healthcare, consumer staples, all defensive plays, all of a sudden etched up to the top 1 month in the green. That's very defensive. Everybody's moving their money defensively towards the end of the year. Energy, information, and financials all down at the bottom. No surprise. So that also tells us everybody short term is going defensive, and most likely, we're going to have either a sideways or pretty much a repositioning of monies into safe allocations to the end of the year. So we're the Twomey Stock Market Report. I'm James Twomey. Today is Monday. Happy trading. Go to the number 2, mestocks.com. That's our website. There you'll get our weekly newsletter. 20 pages of information and analytics, both fundamental analysis as well as technical. Great read over the week to get you prepared. In addition to that, we have trade alerts. We have all our trade tracker update there, so you can always go in and find out what we're trading. And then we also send you trade alerts. So when we make a move in the market, you hear about it. I'm James Twomey. This is the Twomey Stock Market Report. Join us at the #2mestocks.com.